Welcome back, investors, to Ticker Time News. I'm Adam, and let's talk about Nvidia and go on a deep dive through their earnings report. Now, Nvidia posted their Q3 earnings yesterday, right after the close of the regular session, and they reported some what seemed to be positive news, right? And we'll dive into that, including what appears to be, and this is possibly the biggest positive development, a bottom in gaming revenue. Have you heard that yet? A possible bottom in gaming revenue for Nvidia? Well, when I went through their earnings report and listened to that earnings recall over again, because obviously we finished up the live stream past the earnings call, but when listening to that, there were some interesting cues that Nvidia gave. And we're going to talk about that too. Now, the chip maker's second straight earning miss with their light Q4 revenue guidance are keeping shares in check today. You can see the stock barely moved, down 1.4% on the day. It's up 0.5% in the after hours because I think people are starting to realize what that earnings report was really about. Now, the broader market ticking lower, that's also weighing on the share price for Nvidia. Now, on the chart here, this is Nvidia's stock chart. This is a daily view on the chart, so each candle represents one day. And you can see we've barely got a candle for today. The body of that candle is awfully tiny, awfully small. But we did reconnect with the 5-day EMA yesterday, and of course, stayed connected with it today, which is awesome, because we spent 3 days disconnected from that. This thing just ran up too far too fast. Now, Nvidia just could not break out above that sticky $163 a share area. We talked exactly about that yesterday as one of the probabilities for today. Now, investors were likely not expecting robust headline results in Q3 after several chip makers warned of a rapidly deteriorating demand backdrop in the months leading up to Nvidia's report. In fact, Nvidia already warned that Q3 would be challenging just last quarter, expecting sequential declines in gaming of about 26% of total revenues. And professional visualization, let me get that word out, of about 3%. Now, there was a 460 basis point contraction in non-GAAP gross margins year over year to 62.4% at the midpoint of its prior guidance, so not too far off. Although Nvidia's gaming and ProViz predictions materialized, declining about 23% and 60% quarter over quarter respectively, margins dipped further than expected, tumbling 10.9 points year over year to 56.1%. This helped fuel Nvidia's double-digit adjusted EPS miss, a blemish that may be clouding out other positives in the earnings report and on the earnings call. One such positive was revenues falling less than analysts anticipated, dropping about 16.5% year over year to $5.93 billion. The heavy lifter here was Nvidia's data center segment, which is about 65% of revenue, which delivered 31% growth year over year and 1% sequentially. Nvidia remarked that growth was broad-based across leading U.S. cloud service providers, consumer internet firms, and other vertical industries. Meanwhile, the weak sequential growth was mainly due to lingering fragility in what country? China. Nvidia's Q4 revenue guidance of $5.88 to $6.12 billion slightly missed estimates too. However, we think it is better to focus on the silver lining that Nvidia expects a sequential improvement in gaming sales, signaling that the worst of the slowdown in demand may be over. It may be behind us. Recall that Nvidia's strategy last quarter was to reduce sell-in over Q2 through Q4 to let channel inventories automatically correct. Now, Nvidia is still working through the correction, But given the sequential growth forecast, Nvidia seems on track to deliver on its Q2 expectation to enter fiscal year 23 in good shape. Margins are also expected to make a good recovery, with Nvidia targeting non-GAAP growth margins of 65.5% to 66.5% in Q4, translating to only a 100 basis point contraction year over year at the midpoint. Even though investors do not seem to have much appetite for Nvidia shares today, the company's Q3 report was mostly positive. There are still a few lingering concerns, so don't get me wrong on that fact, such as softening gaming and data center demand in China, which cropped up towards the end of Q2. China is Nvidia's second largest market in terms of where products are initially built, comprising around 26% of total revenues in fiscal year 22. Second place is Taiwan, making up about 32%. Hence, weakness in the region adds a layer of uncertainty. ProViz is also finding it more difficult to recover than gaming, with Nvidia forecasting basically flat growth quarter over quarter in Q4. Still, we think Nvidia remains a solid long-term play, but caution that it is relatively pricey. It's sitting at about 40 times forward earnings, a sizable premium to AMD. AMD is about 23 times, and Intel, they are sitting at about 20 times. Could continue to create volatility with that price evaluation in the near term. Okay, that's my thoughts there on Nvidia and their earnings report and earnings call. I don't think it was that bad. There are some concerns, but mostly long-term play looking good. Try to get in on Nvidia sub 150, sub 140, even better. Sub 130, of course. The further we go down in the short term, the better for your long-term portfolio's growth. Okay, let's talk about today's trade. Also, let me know if you like the deep dives on the earnings reports on certain companies. I'd be willing to do that. It was kind of fun. And we used to do that, matter of fact, when we first started this channel. Okay, let's look at today. Today's trade started on a weaker note. There was a big gap down. Market participants again dealt with concerns about the Fed over-tightening and forcing a recession for the U.S. economy. That would be a hard landing. These concerns were stoked by comments from Fed officials ahead of the open, specifically St. Louis Fed President Bullard, who's a 2022 FOMC voter. So his vote counts. But anyways, Bullard acknowledged that the Fed funds rate is not yet at a significantly restrictive level, and then showed a Tyler rule exercise that the Fed may need to go to 5 or all the way to 7% in the battle to get inflation under control. That's a huge statement. Remember, we think the Fed will go to 5% real easily by Q1 of 2023. They'll be at 5% for the Fed funds rate. Anything above and beyond that, the market is not prepared for whatsoever. And Bullard saying 5 to 7%. Remember what we were talking about yesterday with inflation and how what if inflation is coming down, but it doesn't come down far enough? The Fed goes up to 5% for the Fed funds rate, but maybe inflation only comes down to 4% or 3.5%, and then it stays there. It's stuck. It won't go any lower. What will the Fed need to do? The Fed will have to go past 5% and possibly all the way to 7% to get inflation down to the 2% target. That's a wake-up call for the market, because the market was nowhere prepared to hear a Fed official say 7% for the Fed funds rate. That is huge, huge. And then we had Kansas City Fed President George, who is also a 2022 FOMC voter, so his vote counts for this year, at least for one more meeting, that is, the December meeting. But her path, or her part, said a real slowing in labor markets and a contraction in the economy may be needed to get inflation under control. So there you have a second Fed official just today before the market opens saying, hey, wait a minute, the Fed funds rate may need to go to 7%. And another Fed official saying, hey, wait a minute, unemployment may need to go up and the growth in the economy may need to go down, negative terms, that is, to get inflation down to that 2% target. No way is the market prepared for that. So there was some indigestion in the market today because of those statements. They're not prepared for it, but we are, because we've been talking about it for a while now. Okay, for the stock market and the participants involved in the stock market, you and I, these remarks piled on to worries about higher rates ultimately leading to a further deterioration in the economic environment, which would lead to further slowing in earnings growth prospects. We've talked about that before. The earnings recession. Q1, Q2 of 2023, earnings recession, it's looking more and more like it because the Fed will not be able to give us a soft landing. It will be able to give us a hard landing, which will be a full-blown recession. And how deep will that recession go? Well, if you look at the 3-month to 10-year yield inversion, that's the Fed staple, not the 2-year and 10-year, but the 3-month and 10-year. That thing is so inverted right now. It is ridiculous. And that has predicted a hardcore recession every time in my lifetime thus far. So it's pretty darn accurate. Now, stocks and bonds, they did not like that Fed speak. But guess what did? The dollar. Before we go diving into other charts here, let's look at the dollar because the dollar loved that Fed speak today. You can see here on the chart, this is again the daily view for DXY, the ticker for the dollar. It has been getting crushed. But the last few sessions, the dollar has started to consolidate, and we could probably go something like this, okay? And something like, oops. There we go. Maybe something like this, trying to get some sort of perspective. And we got a descending triangle potentially there for the dollar. Look at this. Let me show you. Let me show you this. We're going to go to chart patterns here. We look for a downturn, okay, with a flat bottom, all right, and a sloping down top. It's called a descending triangle. I thought bringing these into the live streams would make it a little bit more easier for all of us to identify what we're looking at. And if you see here on this specific chart pattern, we have initial, we're in a downtrend, right? Let me change the color since that's all. I probably shouldn't have gone to red either. We have a downtrend, right? That's what we're in. And then we go to a consolidating pattern right here where the bottom is relatively flat and we have a down sloping resistance line, all right? These are neutral or bilateral patterns, meaning once price tightens, price can break up or price can break down, kind of like a symmetrical triangle. You've seen those all over the place. They're really easy to spot. Well, this descending triangle, and again, let's go back to the dollar to show you. As you can see, we were descending. We had a big steep sell-off, right? Now we've got a flat bottom right here, and we've got a down sloping resistance line. This can literally break either way. All right. So for the dollar, if it's going to break to the upside, what's that going to do to equities? The SPX, the SPY, it's going to crush it, crush it, crush it, crush it. Okay. Now, if this does break down, we do have the 200-day moving average sloping across like that. And we're going into another area of prior support. So 200-day moving average and prior support meeting right here. So if the dollar does break down, I don't think it's going to break down very far. I think it'll go down to the 105.4, 105.3 area, and it could potentially bounce from there and pick up some steam again. So I don't think the dollar is out of this fight just yet. This is the one chart that I am watching very closely, because this chart is going to tell us where and how the SPY and the SPX are going to move. Okay, so keep that clear. We look to be, and let me pull this up again with the chart patterns. We look to be in a descending triangle right here. And as you can see on the chart, it can break up or down. All right. This is not a bullish or bearish chart pattern. This is a neutral chart pattern. So it can break either way. So keep a very close eye. DXY is the ticker. And I'm glad to see this. And I'll put up here for everyone else. The deep dive is always useful. Thank you for saying that. I will do more of them. Absolutely. They're fun to do. I learn a lot, and hopefully I can share with you what I've learned to help you understand whether it's a good investment or not. All right, let's keep moving on. So the dollar like this, that's about it. The rest of the market didn't. All right, let me go back to the SPX, and I'm going to show you on the 5-minute chart here in just a moment. One thing to point out, the SPX did finally reconnect with its 5-day EMA today. That was a real long time being disconnected to it. Let the chart update here. Don't get scared away from this. It will take a moment for me to get it just right, dialed in, so we can all see what I want to talk about here. But trading intraday, and I want to use today as another example of trading intraday, what to look for, how to trade. All right. That's something I want to talk about today. I also want to talk about a few stocks that you should keep on your radar. They're on our watch list right now. And the reason they are is because they are playing a big role in the direction that this market is going to go. Okay. This is the 5-minute chart for the SPX, which is, it's going to look very similar to the SPY, but I like to use this one better. There's more volume. There's more money pumping through SPX. And again, that relates to, and it tracks the S&P 500. Okay, what do I have here? Number one, let me do this. I'm going to take it off because I want to show you how to do it. So what I did yesterday, we closed okay. All right. It was a red day, but it wasn't too terrible. We opened up with a huge gap down this morning. So let's say you were a trader and you entered into a position right at the close yesterday. Say, for example, see how yesterday, right before the close, we were kind of holding this support, and then we bounced from that and started to move higher. Well, let's say you bought in on that bounce, and then you held overnight. Okay. So let's say you're here on the breakout. That's where you buy. I'm going to attach an anchored VWAP to that. And then it's going to put a black line on the screen. And I'm going to highlight that line by making it thicker like that. So now you can see it much clearer. Now, what this anchored VWAP is doing, Well, it uses volume, it uses time, it uses price to calculate where the average investor is based on where the anchor position is. So I'm anchoring it to the breakout right at the close of yesterday. So that means this morning with the big gap down, anyone who bought this little breakout at the end of the day would be at a loss, underwater. Okay. Now we get here. Let me get my highlighter back. We get here at about 11:55 a.m. Eastern time. We get a big run. All right. And it goes right to that anchored VWAP and stops. The next 5 minutes, it breaks above it. It uses the next 30 minutes to back test this. It breaks below it, and then it breaks out. On the breakout, this is when you would want to buy, okay? Usually, these anchored VWAPs act perfect for this. So you buy, you keep your stop loss tight. This right here, this red line where we maxed out today, this was the low for yesterday, okay? Which is very important. So you ride the breakout from the VWAP, and then when we reach the high for yesterday, if we find resistance there, that's when you close out, cash out, and you take your gain. That's a perfect way to play it. And then you can see on the other way around. We hit resistance. It was tough. We start going down. We get to the anchored VWAP. We play around with it for about an hour before finally breaking down. And then you could short. All right. So you went long earlier in the day, made some profit. Now you're shorting it. Well, where do we go? We stop down here. And what is that? That lines up to the high met this morning after the gap down, okay? So we find a little bit of support there. That's also right around 39.25-ish, give or take. That would have been a very quick 5, 10, 15, 20 minute, maybe 30 to 35 minute if you waited for a green candle to show up where you could have shorted and caught a little bit of extra profit for the day. So there's a quick long that you could have taken and a quick short that you could have taken to maximize your returns for the day. And that's intraday trading. Pretty simple. Obviously, it doesn't. It looks simple when you're doing an aftermarket dive like this, but yeah, that's how using the anchored VWAP, anchor it to something important, a CPI report, a PPI report, a big breaking news story, or a big gap down like this, or even a big gap up, because it could play in the reverse as well. All right, so that's that. I just wanted to touch on that for just a moment to show you kind of how you can use that intraday to trade. Now, let's keep moving on. I'm going to go back to the daily view here. While I'm going to load the SPY here, let me just mention that the Treasury market reacted pretty strongly to the Fed speak this morning. The 10-year yield, it hit 3.68% earlier overnight, last night, but it settled up 9 basis points today to 3.78%. However, the 10-year still closed below the all-important 3.8%, which is the 50-day moving average. And it's now closed below its 50-day moving average for a third straight day. Now, the 2-year yield, it reached 4.34% overnight, and it also rose 4 basis points on the day. Right? I'm sorry, not 4 basis points, 9 basis points on the day to 4.45%. That's where it closed out at. Let's see here. Let's open up the SPY. Let's get it opened up so we can see this baby clear. All right. Now, it was mostly a red market for a lot of risk assets. It was like risk off today. for the most part. There was some. Mega caps did, pretty decent today. Let's pull this up a little bit more. But with the riskier assets being mainly red today, I mean, look at the IWM. It was down 1 percentage point, but the SPY was down 0.3. The Qs were down 0.2. So the small caps, the riskier ones, they definitely took the bigger hit today. So one could easily make the argument that it turned out better than expected. Buyers stepped in, 39.25 on the SPX, which is great. The S&P 500 protected at key support. And it closed back above the 3,900 to almost 3,950. It was 3,946 to be exact. So that was a strong sprint in the final half hour of trade, which we kind of walked through. Now, let's look at the SPY. Down today. Now, something that I'm watching here. We talked about this yesterday as a probability. And I did this. I said, what if we get a down day, all right? And then we get a gap down, okay? And then another down day. That would have created an island topping pattern for the SPY. That's the same pattern that we had back here at the middle of August or at the end of the summer rally. Watch very closely to see if we get a gap down tomorrow, because if we do, that pattern could be setting up. Now, I would like to point out that today it closed real close, the SPY that is, real close to the 50% Fibonacci retracement level. That's important. If that holds as support, that to me would be bullish. And that's at 390, right at 390. That's where that 50% Fibonacci retracement level is. And we closed at 394, okay? 390 is that 50% retracement level. It could act as a support. Right below that, we have the weekly expected move, which is 388. 388 is a huge support resistance zone, okay? Last time, oh, my Sharpie ran out. The last rally that we were in before today, or before the last few sessions, it acted as resistance, 388. We had to go from opening all the way down here and then gapping all the way up to here to get above that 388. We actually opened at 388.05 and we got to a high of 395 that day and closed at 394. So 388 is going to be really sticky unless we gap through it, okay? All right. Another place here to point out for that 388, it was support back here. It was support, and then it was resistance. Look at that, resistance, FOMC meeting. Resistance, FOMC meeting. Pretty important. Pretty important indeed. And then that 388 price point for the SPY, that goes back even further for support and resistance. So it's a very active support resistance line. That's what makes it a very sticky point. Now, if we break down below 388, we have a couple of anchored VWAPs here. The FOMC meeting, the last one that we had, okay, on the 2nd of November, that sits right about here, okay, which is right about 385. That could act as support. And then we have a couple other anchored VWAPs that are down here kind of separating. They were really close together and tight together right before the FOMC meeting, but now they're starting to fan out a bit. So I'm not really looking at those at this moment. If they start converging back together, that's when I'll pay closer attention to it. Next, we've got right here at the 38.2% Fibonacci retracement at 380. That is another sticky spot that has been resistance. right here and support right here. So we've got a few price points there. 390 could be a support area. If not, 388. And if not 388, 380. Those are your three most important price points if we're breaking down. 390, 388, and 380. All right? Write those down. Keep track of them. This is perfect right here. I got a SPY call at 390. Now, if we start moving up, 400 is going to be a very sticky point for the SPY. All right? 400, very sticky. There's a Fibonacci retracement level there. It's the 61.8, I believe it is, right there at 400. And you can see that's where this rally stopped, at that 400 marker. So that's going to be a sticky spot. And then on top of that, we've got resistance up here and the 200-day moving average up here, right around the 410, 409 would be the absolute peak. All right. I don't think if we get a rally, I don't think we get past that 409, at least from how things look right now. Okay. Now, there are a few big names that keep showing up, and they are on our watch list. They are very important. I'm going to talk about those in just a moment. I want to look at the Qs real quick and talk about the setup that I see over there. Not a whole lot has changed. The numbers are pretty much the same to what we've been talking about all week. Now, for the Qs, the 284 area, it acted as support for a couple days this week, but then we broke down underneath it today, and we were not able to get back above it to close above it. So we've got that, and it's exactly 284.9. And we closed, bottom right-hand corner here, 284.8. So literally 10 cents. 10 cents from closing back above that. If we do, I think that's bullish for the Qs. And then I would be looking for 294. That's the 50% retracement level for our decline since mid-August all the way down to mid-October. That would be a very important point if we get back above 284, okay? Then I think we got $10 easily to 294. Now, if we break down, we've got some converging here of anchored VWAPs, anchored to the last FOMC meeting, anchored to the October 13th low of the year, intraday low, anchored to the FOMC meeting on September 21st, anchored to CPI. So there's a lot of different anchored VWAPs, and they're converging here right around the 275 mark. So I think that would hold as support. Plus, at 273, we've got another Fibonacci zone. So 273 to 275, I think that could act as support if we break down. All right. So remember those numbers, write them down. 273 to 275 if we break down. If we go up and we get above 284.9, then we could potentially be going to the 50% Fibonacci level, which is at 294. So write those down, keep them close to you, watch those numbers. They will be important. Okay, so there are some notable companies to watch that could potentially tell us which way this market is going to go. And it's not the company per se, but it's how market participants treat the company's stock around key support and resistance levels. Okay, SPY is one of them. Disney, DIS is the ticker, is another. Now, if you are in our investor community, you got this list of stocks plus a whole ton more this evening. Now, look at Disney. It had a big breakdown because of earnings, all right? But it's kind of marched back up a little bit to reclaim some of that, but then it has fallen. How is it going to react, excuse me here, if it reaches the low that was created after earnings? That's going to be important to watch, okay? Which is down here at $86. It's currently at $91. So we're about $5 away. If it decides to turn around because it is disconnected from its 5-day EMA, how would it react when it gets to this zone up here where its 20-day and 50-day moving averages are kind of converging? Is it going to find support? Is it going to find resistance? That could help determine where this market's going to go. Microsoft, MSFT is the ticker symbol. Let's look at Microsoft, where it's at, and what we can glean from this. Again, Microsoft here, not again, we're just starting to talk about it. It's 50-day moving average. It closed above it today. How's it going to perform now? Will it stay above its 50-day moving average? If it does, that would be considered bullish in the short term. But then we'd have to watch these levels right here, and could Microsoft break through them? So it's at 241 right now. This resistance up here is at 251. If Microsoft holds above that 50-day moving average, that is bullish in the short term. But how is it going to react when it gets to 251? Will it be able to push through, or will that be resistance? If it's resistance, the market's going to go down further. All right, another one is Alphabet, GOOGL. Now, we do weekly expected moves for a lot of these companies like Microsoft and Alphabet. So you get a heads up for where we think they're going within the week. Now, Google, look here at this. It's sitting right on its 5-day EMA. Its 50-day moving average is like, boom, right there. If Alphabet can get above that 50-day, that's bullish in the short term. If it breaks down from that 50-day, that is bearish in the short term, okay? And Alphabet's got some pretty big gaps here that it could fill on the way down if that's the direction it wants to go. Another one, JP Morgan. JPM is the ticker. Let's look at this real quick. These stocks can help you. Watch these stocks and how they perform. They're going to be directional drivers for this market, okay? All right, look here. It is down under its 5-day EMA, but it has way accelerated above its 20-day, way accelerated above its 50-day. Can it hold this type of a lead, this type of a jump? I'm not so sure. And if Microsoft and Alphabet can't hold their 50 days and they break down, JP Morgan can't keep up this big lead because maybe rates start ticking back up like the 10-year. Down comes JP Morgan. Down comes Microsoft. Down comes Alphabet. You seeing a theme here? If these levels that they're at can't be held and pushed higher, then we're going to go for another leg lower. Okay, another one, Visa. Let's look at Visa real quick. Now, again, if you're in our investor community, I sent this list out before we went live. Here we are, extended from the 50-day moving average, extended from the 20-day moving average. It is right here at a resistance point. Can it hold it? Can Visa hold this position? I don't know. I think a pullback would probably be in the cards here in the short term. All right, let's look at another one, IBM, and then I'll be done with them. Let's look at IBM here real quick. IBM, old school computer hardware company. Old school. Been around for a long time. Been on a good run since earnings. But like the others I showed you, it is well off its 20-day moving average, and it is way off its 50-day moving average. I mean, up in the stratosphere. It, as a matter of fact, if we come down here on the bottom right corner of your screen and look, it hit a new 52-week high today at 146.18 right here. Can it keep this momentum? Can it keep moving? Can it keep moving higher? The RSI is at a 75.4. I don't think so. I think this is due for a pullback. Too far, too fast. Too far, too fast. You see a theme that I'm starting to show you here with some of these bigger name companies: Microsoft, Alphabet, JP Morgan, Visa, IBM. They're overextended to the upside. They're gonna pull back. What's that gonna do to the S&P 500, to the SPY, to the Qs? It's gonna pull them down with it. So if these companies can't hold up, if they can't continue this big momentum, then watch out for a move lower. That's all I'm trying to say here. Watch how these companies react to being overextended to the upside. You know what? Let's give you one more. Let's do MasterCard. We did Visa. Let's do MasterCard. Let's see what MasterCard's looking like. And then maybe I'll show you one more. Look at this. Way extended over its 20-day. My highlighter disappeared. All right. Right here. Way extended over its 20-day. Super extended over its 50-day. Resistance is right here, screaming at it. And as a matter of fact, we can say resistance could be right here. It's been there before, and MasterCard's been real wobbly at this 340 level. So watch out. Watch out. MasterCard could be in for a drop here, okay? Which would then pull these down. Pull the indices down. Let's look at one more. Let's go to XLV, which is the healthcare sector of the S&P 500, okay? Healthcare is typically a defensive type sector, but look at this. It's been performing so well that it hit a new 52-week high back on Thursday, November 10th, last week, and it's been slowly trying to pull back since then. It's like almost to its 20-day moving average. My highlighter disappeared. Almost to its 20-day moving average, which is right there. Its 200-day moving average, which is right there, which could act as support. And then its 50-day is way down here. All right. So healthcare with that 200-day moving average coming in like this, that could actually act as support. This is one that could potentially hold up. But if it doesn't, and it wants to get back down to that 50-day moving average, watch out. All of these companies I just went through and showed you, watch out. And these are just a few of the bigger names that have been pushed higher with momentum and are now sitting at a position where if they can't hold that momentum, then they're going to come down. Now, we would monitor these names to see how they're going to respond to, again, support or resistance tests. When they reach that support or when they reach that resistance, how will they react? And this will predict the broader market and how it's going to move. Okay. If you have questions, now's a great time to plug them in. Otherwise, I've gone over my notes for today. And Yeah, I'm just double checking here. Yep, I've covered everything. Okay, so let's see here. Do you ever trade zero delta? No. Zero delta options. No, I do not. No. Have you? Have you done that before? I have not, personally. I have not. And I do not. Recently here, with all the volatility and with the seasonality chart saying that November could just be a choppy ride sideways, maybe choppy sideways a little bit to the downside. And let me just again point this out here. We're looking at November right here, and right here. We could be potentially moving sideways and maybe down sloping sideways for the month of November before finally getting a December Santa Claus type rally. So with that staring me in the face and how accurate that red line has been, which is the line that we should be tracking for this year, with that line being so accurate, I mean, it is real possible, a real probability that for the month of November, we're just kind of, moving like this. And oh, my highlighter disappeared again. And we're just kind of moving like this, just, bouncing up and down and just kind of going between this all November for the next couple of weeks and really going nowhere. So since this sideways movement has seemed to have overtaken the market, I'm doing really short-term trades a day. Not really confident in swinging certain positions at this point, but I'm using like the SPXS or the SPXL to do the longs, to do the shorts on a daily time frame. Again, not real comfortable holding overnight at this point in time, just because it can easily swing to the other side because we're so close to these technical levels and the market just seems to have stalled, which is typical, okay? Because how does the market move? It goes from expansion to contraction, expansion to contraction. So what's the next move? Are we going to expand higher and go up to that 41.15 zone area, the 200-day moving average? If things can hold momentum-wise, sure. Otherwise, maybe we take an extended break to the downside. But again, maybe when we get to the end of November in a couple of weeks, we've basically gone nowhere. That's a possibility. I meant 0 days to expiration. Yes, I have. Yes, I've done that before. Sorry, I thought the DTE stood for Delta. My apologies. I thought I saw an L in there. My apologies for missing that. 0 days to expiration. Yes, I have. I don't typically do that. I like to if I'm trading intraday, I typically use the leveraged ETNs or leveraged ETFs, okay, to do that. If I'm building into, let's say, a short position or a long position, then I'm typically adding a few here, a few there as we get to technical points. Because speaking of going short, I am building a short position right now, and I would rather this market to creep up and go up to 41.15. That way I can continue building out that short position, because I think 41.15, I think that's the limit. And then I think we break down from there. And if I have the opportunity to build into a longer, a bigger short position as this market creeps up to 41.15, then that means I can collect greater profit on the way down. Now, this short, I'm letting it expire towards the end of the month, because I think at some point in December, we are going to see a rally. And the only way to get that rally is if we pull back now. Okay, so I am building a short position. I wouldn't mind if the market went to 41.15, because then I would add into that short position. So then when things change, when they start to fall, then I'm collecting more of a profit on the way down. And then when we get closer to the end of the month, I can either slowly start cashing out of that as we start getting down to lower levels and getting ready for a potential Santa Claus rally. So that's what I'm doing right now on the options market. But on the day-to-day market, I'm just looking at the leveraged ETN / ETF products like SPXL I used this morning. I forgot the X. SPXL, which is the direction daily S&P 500 bull 3 times shares. Let's just go there and look. When the market gets to a technical level and it bounces intraday, this is what I'm using. Like earlier today, when we broke above the anchored VWAP, hopping in on that breakout. And then on the reverse side, when it broke down below later in the afternoon today, SPXS, which is the direction. I like the direction products. I use a lot of their products. Direction daily S&P 500 bear 3X, where you can see the market, the SPX was down 0.3% today. And here we have a 0.97% gain. So this is what I'm using intraday. Yeah, 0 days to expiration. Yes. Use them before. I don't use them often, because this is the strategy I like to go when I'm doing an intraday or a very short-term trade like that. Okay, so hopefully that answers your question there. Okay, any other questions for us today? Or I'll wrap it up. Make sure to do me a favor and click that like button and share this video with a friend. That helps out greatly. Absolutely does. And if you like the perspective and you want more, consider clicking the first link in the description. Okay, I guess that is it. So I will wrap this up for tonight. I'll be back tomorrow after the market has closed to go over what happened this week and what can we expect next week. Hopefully we get a little more clarification on this market. It's really skittish right now. And I think that's because, like I went through and showed you, there's a lot of overextended stocks out there in the market, and they are due for a pullback. So it leaves the market very skittish. I'm holding up. Sometimes they're a good risk to reward. Yeah, if you find the right setup, absolutely. And sometimes, really, that's all it is. Just finding the right setup. Don't force it. Don't try to make it work. Wait for that setup to materialize and then go at it. All right. I'm holding up and waiting. Let's see here. Do you think the market brushes off the 7% Fed rate? Okay, good question. So with Bullard this morning saying that the Fed funds rate may need to go to 5 to 7%, that's a bit shocking for the market. And I don't think the overall market participants heard that. I don't think the majority of market participants heard that 7% and understood what that really meant. To me, that's huge, because I think going to 5%, they're definitely doing that. Probably by the February, February 1st or February 2nd is their first meeting of 2023. I think they'll be at 5% by that meeting. Now, going past that, we have to ask ourselves the question, with inflation coming down, will it drop all the way to 2%, to that target 2% rate, with only a 5% Fed funds rate? Or is inflation too sticky that it hangs around at maybe 4% and it won't go down anymore, which then forces the Fed to have to bump it up past 5% and start heading towards 7% to get that inflation number down to 2%. Now, when Bullard did that, he used a specific model that showed 5% might not be enough. And the model showed him that going to 7%, that's what they might have to do to get to that 2% target, if inflation is just too sticky and it hangs on too tightly. Now, I don't think the market is going to front run a 7% Fed funds rate. If I think that your question here, I think the market will brush off that 7% as just noise in the market, because this market wants to rally really bad. But unfortunately, looking at a lot of components in the market like we went through today, there's a lot of things out there that are overextended and need a pullback. They need a correction, need to do something. They can't just stay elevated like that forever. I mean, IBM just can't make 52-week highs day after day after day. It's got to pull back. So that's what I'm thinking. I don't think the market pays too much attention to that 7% comment. I think this morning's gap down, and if we look at the 5-minute chart here, again, I'm on the SPX, and let me just open this up real quick. But looking at the 5-minute chart, that 7% comment this morning, that comment affected the market. But by the end of today, that comment was already out of market participants' head, except mine. It's still in there for me. But you can clearly see that. The big gap down this morning, and then, I mean, we could kind of put a trend line on today from the bottom across here. If I wanted to just play around with this and put it right there, which kind of captures a little bit of a dip this morning from that trend line, and then just like this anomaly dip later in the afternoon. I mean, from that comment and the drop down, the gap down, the market pretty much rallied the rest of the day. It just wasn't in a straight line. It was in a volatile, choppy direction. So, yeah, I think I'm repeating myself here, but I think the market pays no attention to it. The damage was done this morning with the gap down. Then the market just kind of left it behind as it rallied up for the rest of the day, which gives me, in the short term, a potential bearish bias in the short term because of this, because of the rise today. If that 7% comment was going to do damage, then I wouldn't be able to have that diagonal trend line there for today going up. It would be going down. Let's see here. I should have put that. I'm sorry I didn't put that comment up. I should have, so we could all see it. Okay, what can the Fed do to keep the market from rallying now? The market seems to be calling their bluff again. Good call. Good call on your part. You are absolutely correct that the market is calling the Fed's bluff. 100%. If you look at Fed speak, which is just a term used for when Fed officials come out and they talk publicly, they are sounding very hawkish right now. That's all the Fed can do. There's nothing else the Fed can do right now to get this market to drop. The Fed doesn't want to see the market just take off in a rally. The Fed wants this market to calm down, to chill out, because they don't want the market to rally really big and then get crushed because of bad news, because of a bad economy, because of bad earnings. So there's nothing the Fed can do right now except to speak publicly and hawkishly about the market. Unfortunately, many of the market participants out there don't pay attention to when these other Fed officials speak. Sure, the big hedge funds do, and they pretty much drive the direction of the market. But the average trader out there, they don't pay attention except for when Jerome Powell is speaking at an FOMC meeting. That's when they pay attention. So there's nothing the Fed can do right now to get this market to chill out, to calm down, and to not rally so hard at this point in time. All they have is their public comments that they can make. All right. Any other questions? Let me know. I'd be happy to talk about them. Or if you guys are good, I'm good, and we can wrap it up till tomorrow. So just let me know. I'll give you a minute here. Okay. If you're good, I'm good. So we'll wrap it up for tonight. Thank you so very much for spending time with me. I greatly appreciate it. I love your questions. It's the best part of doing this live stream, being able to interact with you. So thank you for spending your time with me. Again, I greatly appreciate it. I'll be back tomorrow after the market closed to talk about the week, what happened, what to expect next week. And yeah, we'll go from there. So thank you again, and I'll see you in the next video. Take care.